There's no denying that Charlie Munger is a fountain of investing knowledge. Many investors were able to generate very attractive returns by following his advice on what constitutes a great investment opportunity. His latest investment in BID yielded a 15x return. And I, too, purchased shares of BID when the media announced his latest buying and selling. But I wasn't as lucky as Charlie Munger and arrived late to the party, resulting in a 2x return on my BID investment. Munger is famous for his investment approach, which he summarizes with his famous quote, "All I want to know is where I'm going to die, so I'll never go there." Well, Munger couldn't find that place because he couldn't understand the workings of the Almighty. So Munger did what was humanly possible. He applied this approach to the investment world. Munger started analyzing investment opportunities and often found great investment ideas by following a simple strategy of work. Munger started analyzing investment opportunities and often found great investment ideas, Munger stated, and I quote, that many problems cannot be solved in the future. Munger understands that many difficult problems are best solved by approaching them backwards, so he will create a worst-case scenario for his investment in any potential company and then analyze how that company would perform in that worst-case scenario. If that company survives the harsh conditions well, only then is it qualified as a Munger grade investment. Charlie Munger is a proven master investor who has helped Warren Buffett generate returns that have crushed the S&P 500S for many decades. He's also made a wildly successful concentrated bet on Costco that generated a 37x return for his own firm. So we pay close attention to his investing wisdom when crafting our own portfolios. In this video, we're going to look at 3 specific pieces of his investing advice and some high-yielding picks that fit in with it. The first of Munger's investing gems that we will look at today is, and let me quote Munger, "You're looking for a mispriced gamble. That's what investing is. And you have to know enough to know whether the gamble is mispriced. That's value investing. Essentially, what this boils down to is finding a stock where the risk-reward is asymmetrically in favor of whatever position you're looking to take in it to be able to do this repeatedly and successfully. The stock has to be easy to value. Defensive businesses that generate very stable cash flows and grow within a very predictable range year after year, and then pass on the majority of their cash flow to shareholders via dividends and or buybacks are the easiest to value, because the variables are much fewer and the estimates of future cash flows are much easier to arrive at. Midstream energy companies such as Enbridge, utilities such as Algonquin Power and Utilities, and BDC such as Ares Capital, as well as some high-quality asset managers such as Blackstone or BX, now fit this bill. Munger tip number 2 is to invest in high-quality businesses. Munger tip number 2 is that a great business at a fair price is superior to a fair business at a great price break. Businesses make superior investments as compared to fair businesses for 2 major reasons. First, great businesses by definition have superior competitive advantages, which makes applying Munger tip number 1 easier because there is less uncertainty about its future earnings stream. Second, great businesses frequently surprise investors. This is what has helped to drive the superior long-term results of companies like Amazon and Apple, and has literally given companies like Tesla new life. Finally, Munger tip number 3 is to buy businesses that play the long game again. According to Munger tip number 3, it appears that CEOs are now expected to make the stock rise, which leads to all sorts of foolish behavior. While many management teams become enamored with financial engineering techniques to appease Wall Street analysts, in the short term, we want to tell it like it is. True value is created by investing in the company's long-term success. 2 tragic examples of this are International Business Machines, or IBM, and AT. Both of these companies repurchased shares hand over fist at exorbitant valuations in order to excite shareholders and appease analysts at the expense of making aggressive and necessary investments in their future. As a result, both businesses fell into stagnant growth and underwhelming performance, and as a result, shareholder value was destroyed. Because of its strong balance sheet, O is an excellent choice for a portfolio looking to prepare for a recession. A recession-proof business model, excellent management, and a very impressive track record. Its minus credit rating is one of the best in the right sector, and its conservative triple net lease business model has proven its mettle through numerous economic cycles, including the COVID-19 outbreak and the ensuing lockdowns, as well as the Great Financial Crisis. Over time, it has further reduced risk and improved profit margins by amassing enormous economies of scale. It is now the largest publicly traded triple net lease REIT, with a portfolio of 11,733 properties and 1,147 tenants operating in 79 industries. As a result of all of these qualities, the REI has a phenomenal track record of growing its dividend for 26 consecutive years, making it a dividend aristocrat, and growing its FFO per share in 25 of the last 26 years. It should come as no surprise that its total return performance has absolutely crushed the SP 500S since going public. Finally, thanks to its recent share price drop, it is now available to investors at a reasonable price. Its enterprise value over EBITDA is currently 17.13x, well below its 5-year average of 19.41x. Its price over adjusted FFO is 16.02x, also well below its 5-year average of 18.52x. And finally, its dividend yield is 4.8%. well above its 5-year average of 4.4%. With a recession on the horizon and interest rates likely to peak in the near future, now might be a good time to add it to your portfolio. STAG is another great fit for portfolios seeking value dividends with the potential for an upside breakout when interest rate scenarios improve in the second half of 2023. STAG's Q3 results showed strength when it reported leased-over-lease cash rent growth of 13.6% and same-store cash and AY growth of 5.6%. Cash rent growth for new leases during Q3 was 19.4%, and for lease renewals, rent rates rose 9.5%. This growth momentum should help blunt some of the headwinds from a potential recession on top of its current growth momentum. Instead of pursuing the most expensive properties, STAG's business model provides it with an additional margin of safety during economic downturns. STAG is an industrial real estate value-add investor that typically targets properties in secondary markets that may have various issues that weaken its market value, such as above-average vacancy rates, short remaining terms on leases, and/or deferred capex. As a result, it can often buy these properties for less than they're worth, and then leverage its scale cost of capital and industry contacts and know-how to create value in the properties. In the event of a recession, each individual investment will have more downside protection. Aside from these numerous advantages, the stock appears to be reasonably priced. Its current P for FFO and P for ATHO ratios are 14.99x and 16.62x, respectively, while its 5-year average P to AFO ratio is 16.11x, and its 5-year average P to FFO ratio is 17.37x. Additionally, its EV to EBIT is only 16.72x compared to its 5-year average EV to EBIT of 17.36x, and its P to NAV ratio of 0.920 and STAG are two high-quality real estate businesses that are on the bargain rack after the 2022 sell-off. Meanwhile, with a recession likely on the way and interest rates poised to peak and possibly even begin falling this year, now appears to be an excellent time to position your portfolio to profit with defensive names like these.